It's all about the Federal Reserve again for the global financial markets. This is Ilya Spivak, head of global macro here at tastylive, and you're watching Macro Money. And we're going to break down exactly what is on the menu here in the week ahead. It is a potent week of macro event risk, and once again, it is centered on the U.S. and the Federal Reserve. So what we're going to do here is take a look at what is on the menu and put it in context of what's been going on here in the past week. See if we can't make sense of where these markets might be heading. Here is what things looked like last week. And the thing that you immediately notice is for all of the fire and fury around the financial markets with the here again, gone tomorrow tariff drama that we were watching break out when we seemingly levied tariffs last week against Canada and Mexico, only for those to vanish within 24 hours of their announcing. For all of the back and forth there, we end up with another week where stocks struggle. They don't necessarily have as bad of a week as the prior one, down 1.1% the previous week, down only 0.3% last week. But nevertheless, we end up lower. On the NASDAQ, we end up with just a little bit of a better outcome. We manage to squeeze out a goose egg there, flat on the week. That's after a 1.5% decline in the prior week. So relatively soggy there on stock markets, but most of the action seemingly again happening in bonds. We can see here the 10-year yield lower, second consecutive week there, down by 1.1%, but the front end up. A 2% rise there. Crude oil continues to slide, down 2.1% last week. Gold continues to rise, almost another 2% rise there. The dollar mixed, and the degree to which it is mixed is, of course, very interesting because the euro is down a little bit, but the yen is up, seemingly rhyming with what we see at the 10-year yield. Generally speaking, the yen tends to strengthen when U.S. borrowing costs get cheaper. That's a general sort of through line for the motivations behind what typically determines the yen's level, which is, of course, what has come to be called the carry trade, where people borrow cheaply in the yen, which has offered next to free credit for past 4 decades almost. And there's been a strategy, of course, around borrowing in yen, then selling that yen to buy other higher yielding assets, such that the higher yielding assets pay you interest. The yen loan is deducting very little, if anything at all, from that interest. And so the strategy ends up looking like an income stream of relative credit spread. And we end up with a situation then where when yields go up, the attraction of the strategy is greater, and so the yen tends to go down in anticipation that people would deploy it more. And when yields go down, in particular at the long end, the strategy tends to invert on itself, where people start to divest of these carry trade positions, buy back yen to pay down their loans. And so you end up seeing yen higher when yields come in, especially the 10-year and longer term. So you have a sense here that there was some rhyming with that in the equities and bond markets. Not surprising that the dollar is on the whole a little bit stronger outside of the yen because, of course, it has a kind of haven appeal by virtue of its unrivaled liquidity. So that stocks were soggier last week certainly rhymes with a dollar that's a little bit stronger, benefiting from cashing out. But that the standout in the other direction is yen at a time when yields are down seems to speak to some narrative consistency. And Of course, when we look at crude oil and gold, they seem to be moving to the beat of their own drum at this point. Certainly not unhelpful for gold that yields are down, at least at the long end, and that the dollar is mixed. That's better on balance than if the dollar were stronger and yields were higher as it comes to gold. But it doesn't look necessarily like those are the dominant influences. It looks more like perhaps Chinese reserve buying is back in the gold market and is now a consistent sort of tailwind, much as it was through late 2023, early 2024. And as it comes to crude oil, it continues to move around its own considerations, seemingly mostly reflecting supply-demand dynamics. So what to make of all of this? Well, if we take a look at the upshot, here's the S&P 500 as a kind of general perspective on risk appetite and confidence in the market. And we can see that since that peak just under the 6,200 mark on the continuous S&P 500 futures contract here in early December, we have gone nowhere. We seemed to start something of a pullback into the end of the year. In the first weeks of January, we came to almost retest these highs. And then, of course, there's the gap with the DeepSeek surprise. Here's the gap with last week's tariffs surprise. Another little bit of a gap this week with the reactivation of tariffs on aluminum and steel imports, revived from the first Trump administration and paused during the Biden tenure. Little bit of a gap again there, but nothing to speak of by way of directional conviction. We're standing still. The markets are seemingly trying to figure out their bearings. On the one hand, they're not running away with any of these risks into something more dramatic, more panicky, but also they are not finding the conviction to rally through the highs and make a real break on the upside. So as we look at where things have been, really since this top, we've struggled to even come back to touch it. And the last run that we made in its direction has now produced a series of lower highs. So the market is seemingly lacking of conviction either way. What's interesting is that is decidedly not the story when we look at the bond market. Here, as we were just saying, yields have been marching significantly lower. This is ZB, the 30-year future. So when we look at this, of course, assume that, as ever, bond prices and bond yields move inversely of each other. So when we see that this is going up, that is, the price of the long-end bond is going up, we find that interest rates are going lower. So if we look at where this spike was right here, this was actually the weakest in 8 weeks that we saw on long-end rates. And of course, in the same breath, the strongest on the bonds themselves. So clearly, even though equities are standing still, the bond market seems to be onto something. It seems to be sniffing out some sort of a reason why rates might be needed to be lower longer term. And that's what makes for the context as we enter this week. Now, we can see that at the front end of the curve, we have virtually no change since November of last year. And this is the first and perhaps the most important insight that we have going into what this week will be the first batch of monetary policy event risk, the 2-day testimony from Fed Chair Jerome Powell. He is showing up for the semi-annual sit-down in front of Congress this week. On Tuesday, he goes to the Senate. On Wednesday, he goes to the House of Representatives. The prepared remarks in both outings should be about the same. So The key then is the Senate, because in the House he will say largely the same stuff. The question and answer session, of course, is going to be different, and of course the people asking are going to be quite different. So the two events can still produce independent event risk depending on what Powell says in response to the questioning, but it's really the Tuesday outing that's key. And we go into it with a sense that the Fed was very dovish in September. We can see that in this policy curve right here. That was when the Fed issued a 50 basis point rate cut and promised 50 basis points more through the end of 2024. Here is those adjustments here. In fact, you can see at the current curve here, this is as of today, we are 50 basis points lower than even September's rate, which was itself 50 basis points lower than the preceding one. So 488 minus 50 is 438. And you can see that already by November, the market adjusted this trajectory to be much less dovish. First, of course, because the economy was already looking like it was heating up by the time the Fed issued its September guidance. And so it already looked like it was behind the ball. But secondly, because, of course, by the November 7th meeting, we'd already had the election outcome and all the pre-positioning before it. And the one thing the market seemed to take away from Donald Trump's win, resounding though it was the likelihood that the policies on offer might be inflationary. And that's in part the pro-growth side of the equation, deregulation, lower taxes. That's something that's likely to boost growth, and in so doing stands to boost inflation. Secondly, there is the tariffs and whatever disruptions to labor markets might occur from a significant deportation effort, where if the price of labor were to go up or the price of imports were to go up in a way that was pulled into overall inflation, then you would end up with higher consumer prices overall, and that would be something that could constrain the Fed's capacity to cut, on top of an economy that was already reheating, as we've just mentioned. And so you can see from September to November, already there was a significant rethink of what Fed policy would look like. And since then, we can see things haven't really changed. The December meeting right around here, and frankly, there wasn't even really a point to single out January's meeting. We just went straight to February's current curve here, because all of it from November onward is kind of clustered in here. And you can see that on this basis, the Fed is not expected to make any kind of a move on rates until sometime into the second half of the year. A 25 basis point cut is not even fully baked in July. In August, there is no meeting. So somewhere between July and September, there is a cut. And then a second cut is all but fully discounted for year end, but not quite. In fact, if we take a look at the aggregates here, we can see 36 basis points in easing at this point are baked in for this year. That's leaning in the direction of two cuts, but somewhat on the threshold. So 11 basis points out of a second cut are being baked in here. So 25 basis points is one cut, 36 basis points is 11 basis points more. That's about a 44% chance that there is a second cut. And then for next year, we're looking at only 17 basis points being baked in. That's 17 out of a standard size 25 basis point cut, or 68% chance of a single reduction. Needless to say, that is a far cry from where the Fed is as of their December forecasting, which is really what sets the stage for all of this. If the market is baking in 54 basis points cumulatively this year and next, and the Fed, as we can see from their December forecasting, has priced in 50 basis points this year, from 4.4 to 3.9, and then another 50 basis points next year from 3.9 to 3.4, then the markets are light by about 46 basis points. That is to say, the markets have priced in 2 cuts this year and next, and the Fed is looking for 4. So there seems to be room here for an adjustment. And herein is where things get interesting. The message from Mr. Powell has been, this is not a year where the Fed is in a hurry. We're fine-tuning. We're looking for small changes. We're looking at data most of the year to make sure we get this last mile of disinflation right, to get ourselves on the right path forward. And so the name of the game for the Fed here is gradualism. Meanwhile, as we can see from what's going on in the curve here, the market seems to have sniffed out that there is something that might require lower rates downwind. As if to say, if the Fed is not going to cut now, they might have to cut more later. And we already see that we're underpriced here relative to what the Fed itself thinks. So if Powell is operating on this basis, he may well come out and say, well, there's not a whole lot going on. There's not a whole lot that's changed. We're carefully watching our mandates and we're not doing anything quickly because we are only just fine-tuning now. Don't expect us to be very active this year. Meanwhile, the markets are saying, hold on a minute. If you are going to be reluctant now, you're going to need to do more later. And indeed, if we look at the touch points where these moves have been made, most impressively, last week's surge, we find that it is in this cool down in U.S. economic data. Last week, we got PMI numbers from S&P Global and from ISM, the Institute of Supply Management, and they both told us the same story. A rapid deceleration in the critical service sector at the start of this year that has significantly reduced overall speed of economic activity growth to the weakest in a year. And so the markets are not unreasonable, seemingly, in expecting that delaying the Fed rate cut cycle now might mean more easing later. And if Powell is to say basically all of what we might expect, that is, nothing is happening quickly for now, then the markets may well continue to push this higher, expecting that to be more of a story the longer we tarry. That is a live conversation, of course, as we get the first big piece of data this week. That's the U.S. CPI report. Expectations here for steady at the headline at 2.9%. But for a little bit of a downtick on the core, the bit that the Fed cares most about because it's where they have the most agency. They can't exactly force global food and energy costs this way or that. So the focus here clearly on the service sector where we can see most inflation is currently stuck. Here, we're looking for a move to 3.1%. That would be a meaningful improvement. It would be the lowest that we have seen this number in quite some time. As a matter of fact, the last analog that's comparable is all the way back to the 3% that we saw in April of 2021. So as we look at this, then, do we have the case for the Fed to maybe move faster? Well, that leading PMI data that we saw last week does seem to endorse the idea that the service sector is cooling because the price component here went down, indicative of less of a demand pull on activity. And so it does seem like we might get more cooling in this critical part of the equation where, of course, we can see most of the price growth remains locked. So a bit of a downtick does seem to make sense. But if we look at the overall dynamics, they are mixed at best. We know the Fed likes to follow these 3-month and 6-month annualized readings to get a sense of inflation dynamics. And we'll focus on the core here since that's where the Fed is most focused. And we can see this green bar here over the past 3 months is getting higher. The yellow one has thankfully month to month started to come in a little bit. So at least the dynamics of the 3-month percent change in core is getting a little bit better when it's annualized. But at the 6-month mark, the trend is still in the wrong direction. All of that, in addition to the Fed being gradualist, seems to suggest, again, we're not going anywhere fast, most likely, as long as inflation prints broadly in line with forecasts. It is a similar story for the retail sales report, the next big inflection point at the end of the week. Here we're looking for a bit of a downtick, a 0.1% decline expected for January. And again, this will be an important question about that very same dynamic. Are we, in fact, in a place where things can be left at even keel, or is there some sort of a concern around the business cycle that's being telegraphed in what the bond market is doing here? Again, this move right here. And markets are ostensibly right to be a little bit jittery. We just got University of Michigan consumer confidence numbers last week, and they were quite market moving, as a matter of fact, because what they revealed is a lurch lower across all measures of sentiment, the overall sentiment index, as well as the evaluation of current conditions and of forward-looking expectations. And the backdrop for this was this very, very dramatic surge in 1 year inflation expectations, up to 4.3%, back to levels we haven't seen since back here in 2023. So why is this occurring? Well, reading the respondents' survey in this University of Michigan report, we find it's tariffs. It's talk about the impact of tariffs on prices. That's the bid up in the 1 year inflation outlook most significantly. That's the biggest contributor, it seems, and that's why sentiment seems to be receding. Now, we can see that since the Fed started its rate hike cycle in early 2022, inflation expectations peaked. They have since come down. Consumer sentiment has since improved. Well, maybe we're starting to turn in the opposite direction. And if that shows up in the retail sales report with an outsized decline, well, then whatever concern we have about growth gets a lot more validation, because consumption, of course, is the largest contributor to overall U.S. growth by a wide margin. Close to 70% of GDP growth is household consumption. So this would be validating, perhaps. Now, it need not be very dramatic. When we look at the way that U.S. economic data has performed relative to expectations, over the course of the past 2 months, really since the beginning of the year, this Citigroup Economic Surprise Index suggests we've increasingly kind of anchored around zero, which would imply that increasingly economic expectations and realized results have converged, that the U.S. economy is behaving about as forecasts would expect. So if we get a relatively neutral Powell this week, and if this suggests that retail sales and CPI print, let's say, broadly in line with forecasts, well, then we're left with this. That is to say, we probably have the markets concerned, as they were last week, that this bit of forward-looking guidance suggests that we need some sort of a lower rates environment downwind, but that in the near term, expectations are going to remain anchored and the Fed is not going to be in a hurry to move. That is to say, exactly what happened last week. And what that means for equity markets, well, we're going to have to find out. But so far, that status quo, the absence of deeper Fed rate cut speculation in the near term, coupled with the, let us say for now, preliminary appearance of some sort of a cyclical concern into the second half of the year and thereafter, so far, what it's done is it's cautiously pinned equities in place. If we get evidence that the Fed is going to resist easing and the data endorses their inaction, this slight tilt lower might well accelerate as the markets become more concerned that growth will cool and the central bank will be late to have a countervailing plan for it. And that is Macro Money for today. As ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. I'm back with Chris for Futures Power Hour, Mondays and Fridays. On with Victor Jones for The Price of Truth on Tuesdays. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com. Commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.